What looms next on the horizon for the North American economy, and have we really made much progress from the Great Recession? Joining us now to debate that, in the nation's capital, Don Drummond, the Matthews Fellow in Global Public Policy and adjunct professor at the School of Policy Studies at Queen's University. And here in studio, Armin Yalnizyan, senior economist with the Canadian Centre for Policy Alternatives. Susan Christofferson, associate professor of finance at the U of T's Rotman School of Management, and Brian Milner, senior economics writer and global markets columnist with the Globe and Mail. And Don, it's great to have you on the line from Ottawa, and to our three guests here in the studio. Pleasure to see you two again, and you for the first time here. Thanks for joining us. Well, we heard Martin Wolf describe the collapse of Lehman as the trigger that set off the bomb that led to the Great Recession. And I guess, Don, let's start with you. I want to get a sense from you about where you were and what you thought 5 years ago this month when that trigger did in fact go off. What did you think it meant?
Well, first of all, where I was, of course, I was right in the thick of it because I was a senior vice president at TD Bank. I'm with Martin, though, that it wasn't the single most issue that grabbed your attention. We had for some time in TD Bank, all of the Canadian banks, been having a greater difficulty in getting capital and paying a higher interest rate for it. So it was a shock when it went down. It was also a shock that the authorities let it go down. It's interesting from the Canadian perspective. Lehman Brothers was a fairly small company. It was much smaller than any of the Canadian banks, but it, as he indicated, was operating with a very large leverage ratio. We, of course, knew that and knew there would be a lot of collateral damage. So both a shock that it went down and a shock it was let it going down. But remember, AGF and others were teetering on that edge as well. So I don't really think it changed the game that much by itself.
You want to just take 20 seconds and tell everybody what you mean when you say leverage ratio?
Well, this is how much financial activity you have relative to the capital base. So they were taking only $29 billion of capital, but doing so much business, lending out so much money, investing so much in equity markets themselves, that they had a huge total financial book, but all resting on a very small capital base. All fine when you're making profit, but it didn't take that much of a dent in their profitability. In fact, running losses not even all that big, with such a small capital base that really they became valueless.
Gotcha. Armin Yalnizyan, you remember where you were and what you thought when Lehman went down?
Well, it wasn't just Lehman going down. That was like a one-off story, and I agree that it was kind of surprising, but not that surprising that it was allowed to go down. But it was the domino effect within the next few weeks that made me think, wow, everything that I've been taught and everything that I've done my entire professional life is up for grabs and for rethink. You know, for all of my professional life as an economist, I was trained to believe that we needed more markets and less government. And here was a situation in which the markets had screwed everything up for everybody and then turned to governments cap in hand to say, can you fix this? And just the response of governments all around the world in lockstep, through central banks as well as through, financial bailout programs, was so rapid and so coordinated that it made me rethink, geez, what do I understand about economics these days now? I think all of us were doing a bit of a rethink about what did this mean, at least in those first few months.
Susan.
Yeah, I was actually just about to enter my, MBA teaching and sort of trying to put this into perspective for students and trying to sort of help provide the picture. And I think as little tidbits of information were coming in, I think one of the things that was, for someone that was sort of more on the outside, was trying to figure out, how do I distill this information that's coming through? And how serious, and I think as we got further and further into October, just how serious the problem really was.
At the beginning, as you were walking into that class, did you have some sense that people in your shoes 100 years from now would be teaching what happened 5 years ago?
We're still teaching this type of, we're still learning from it. We're still learning about, what the interconnectedness of the banking system, how interconnected the shadow banking system, how severe of a role it played.
Shadow banking?
So shadow banking being a banking system which is not fully regulated, doesn't have access to the central banking system, but it played a very significant role within this, within the crisis. And we're learning about that, learning kind of the effect that it had, and teaching that to the students. So hopefully when they get into working for banks, they can actually...
they won't do this too.
Well, no promise.
It'd be nice if you pumped some real sharp MBAs out there who didn't make the financial system collapse, but...
Yeah.
Right? I hope.
Yes.
Okay, just checking. Brian, how about you?
Well, I think the fact that Lehman was allowed to fail was a shock, because they had already, by that point, the U.S. government had already bailed out Fannie Mae and Freddie Mac, the giant mortgage companies. They had already engineered a takeover of Bear Stearns, which was the first big Wall Street firm to really collapse. They were talking about doing it with others. And we know, in hindsight, that they had many, many meetings about how to salvage Lehman, and we know that Barclays, the British bank, came very close to acquiring it, but that the British government blocked the deal, which was a great move by the British government. Saved Barclays from itself, because Barclays had this desire to be a major Wall Street bank at the time. When they allowed Lehman to fail, I believe that the government, including the Treasury Secretary and the central bank governor, did not understand the interlinkage, especially in the derivatives market. And they didn't understand Lehman's role at the center of countless billions of dollars worth of trades that would trigger what happened after that.
If that's the case, Don, do you think then that the governments of the day made a mistake in letting Lehman fail rather than saving it as it did for so many other institutions?
I think it would have helped, but I think essentially we would have gone through the same thing. The problem was, with the exception of Canada, for a variety of reasons, the world went through this meltdown of housing markets, and it hit all the financial institutions, and you could have papered over to some degree that difficulty, but you still had to deal with that enormous loss of wealth in the hands of households, the enormous hit to the bottom line of all the governments, and of course the wipeout of financial institutions. Could have put in government money, but I don't think it would have fundamentally changed the course of events over the 5 years.
Armenia Alnesian, do you remember where you were exactly 5 years ago?
I think somewhere around here.
I think you're right there, actually. I think you were on this set because you and I were having a little conversation about what you thought. It was a post-Lehman collapse discussion here in the studio, and I wanted to get your sense of what you thought about Wall Street, in effect, having its losses socialized. And let's just play a little bit of that, shall we? Control room, roll tape, please.
It isn't really a rebuke of the president. It's a rebuke of this hands-off-the-wheel type of capitalism, where basically markets can do no wrong. And what we're seeing is, credit markets really overreaching and having this kind of implosive effect. There's three sets of players here. As John said, there's the underlying fundamental, which is what's happening to housing prices and the assets behind mortgages. But there's also the bankers that lent the money lenders to begin with, and the people that invested in, hey, this looks like a really sweet deal. So these three sets of players are suddenly embroiled in a way that nobody really expected to see this kind of rat's nest develop out of it. And the striking thing is that the government now knows it can't not act. In fact, the package is being badly characterized as a bailout. It can be viewed as Wall Street welfare, but it can also be viewed as the stabilization that's desperately needed to make sure that the wind down of housing prices isn't so precipitous that it just makes values evaporate. And that's what they're trying to do. They're trying to stabilize the wind down of the housing bubble so that the architecture that's been built on top of that doesn't collapse on itself. And that's exactly what government should do.
I think we got into that originally. First of all, you haven't aged a day, so congratulations.
We've had a different show about that in between times.
That's true. But I think what precipitated that answer was my asking you, how do you feel about the fact that Main Street's going to be bailing out Wall Street, and doesn't that make you sick? And your answer came back with, hell, government's got to save the day or else the whole thing's going to go down the toilet. Still feel the same way about things 5 years later?
Actually, I was really struck by what Martin Wolf said. And at a very meta level, we're asking really profound questions about whether capitalism even works anymore. And I think that is the big question that got posed in the fall of 2008 is, if we get back on track, supposedly, like we get past this bump or this hiccup, what are we getting back on track to? Is there something about the mechanism that we're on, the track that we're on, that now veers towards falling off the rails very frequently now, whether it's because of growing inequality? Don't forget, the story of growing inequality in the United States is intrinsically entwined in what happened in the housing market. People that couldn't afford to borrowed money, and people laid bets that they would pay those bills no matter what happened to them. And I just think the track that we're on right now shows in the United States, 95% of all economic gains from the recovery thus far have gone to the top 1%. This is not a stable platform for investment and recovery going forward.
So, Brian, we've gone through 5 years of whatever it is you want to call what we've gone through for the last 5 years. And if Armin has characterized it accurately, and I have no reason to think she hasn't, we're no better off. We're no better off because the 1% still basically back in the game, and it's like nothing's happened.
Well, we're slightly better off
How?
because governments do have a better realization of the disasters that can await when these things happen. They have put in a little better regulatory systems in some parts of the world. There is a sense that there needs to be a global system of regulation, but that's fraught with problems. Governments don't like giving up authority. It's even happening in smaller segments. In Europe, we see that. The Germans don't want the same rules that they want imposed on the Spanish banking system, for instance. So that's still a problem. It's also a problem that the giant banks that we had before the collapse are even bigger now. There's a greater concentration. So the top 10 banks in the United States now have 40% more assets than they did before the crisis. So all those risks, as Martin Wolf pointed out, are there of another crisis coming, and they do regularly in the banking system, not just 5 years ago, but typically every 7 or 8 years they get into these troubles. The other issue is how healthy is a market where you have a financial system that's basically focused on financial engineering, on creating products that don't actually improve economic performance. They improve their pocketbooks. Shareholders like them, but the rest of the economy doesn't really benefit from a lot of the things that the financial sector is doing.
Doesn't create anything, really.
No, in fact, Paul Volcker once said the only new thing that banks have come up with that's useful is the ATM.
Now, I do want to follow up on something else that Martin Wolf said, where he talked about how banks behaved so recklessly and were completely overlevered and didn't have enough money on hand in order to deal with the huge losses that ended up coming down the pipe once the housing market disappeared. That wasn't the case in Canada, though, was it?
No, I mean, we actually, and I think this is part of the regulatory system, we benefit from the fact that we have very few, very large banks, and we have one regulator. In the United States, there's 3 regulators, or, the states are like 50 different regulators, plus the Fed, plus the OCC. So you have a very fragmented, the Office of the Comptroller of the Currency.
Okay.
So you have a very fragmented banking system. We benefit from having sort of a very concentrated banking system in terms of a regulation. And I think, one of the benefits is that they actually imposed a 10% capital requirement as opposed to the 8% that was sort of suggested or recommended by the Basel Committee. So we were well capitalized. And I think one of the interesting things, if you look back in history, actually the banks going back to the early 1900s actually had much higher capital levels, like 20-25%. And this was before a lot of the safeguards that were put in. So banks were kind of naturally,
saving for a rainy day.
Yeah, saving for a rainy day.
You're talking in Canada only?
Not in Canada only, but across with globally. Okay. So there's a correlation there. In terms of causation. Has this caused the banks to reduce their capital because they know that the government is there to back them up? Is another question. But we have seen capital levels come down. We were fortunate enough to have kind of a very centralized regulation system and larger capital levels than we saw in other parts of the world, Europe and the U.S.
Let me get Don's take on that, because our bankers have taken a lot of criticism over the years for being too risk averse and too staid and too dull. And this might have been one of those occasions when all of those features were actually pretty good. Fair to say?
I think it's very ironic, because the very thing that Canadian banks have been criticized for is the thing that saved the Canadian banking system and in many respects the Canadian economy. And it was that risk-averse behavior, and I think in good part that came to the concentration of the sector. And I don't want to take away from the quality of the regulators, but I just want to add, if we can't put it all on the shoulders of the regulators that they saved the day, because the Canadian banks operated with more capital than they were directed to, and they operated at lower leverage ratios. So if it was all just due to the regulation, you wouldn't have expected that. we in Canada did not have any subprime mortgages. Why did we not have subprime mortgages? I think it's because we didn't have so many financial institutions, and if one had probably come in and offered it, others would have been, but they were making nice rates of returns without going that far out on the risk curve, so why bother to do it?
Actually, you know what, Don,
to a surer model.
Can I follow up on that? Because here's the story I heard, and you tell me if this is accurate. I mean, you'd know, you were at pretty high levels of banking in this country for a long time. What I heard was that Ed Clark, former head of your bank, said was given a presentation one day on subprime mortgages, and the presentation went something like this. Everybody in the States is into this. They're all making money hand over fist. We got to get into this. And he took a look at it and he said, I don't get it, so we're not going to do it. It looks too risky and I don't understand it. Is that true?
An element of it, essentially, he looked at all of the activities being dealt with by all the security operators in Canada and the United States. And he said, half of it I don't understand, and that makes me really nervous. And the other half I do understand, I don't want any part of. That was actually what it went through.
Okay, so
and,
my source wasn't bad on that.
Well, that sort of triggered, we were, and all the Canadian banks were operating at low leverage ratios to start off with, but that triggered a further deleverage process as we went through that.
Armin?
And I can tell you
Brian.
Goldman Sachs, which made one of those presentations, one of their investment bankers in New York called me and said, what's the matter with Canadian banks? This is the most profitable thing we've ever come up with, mortgage-backed securities. How can you go wrong?
Yeah.
Though at the same time, though, I just have to say, though we weren't as exposed as the United States, saying that we had no subprime mortgages is a little bit of a misnomer. Starting in 2006, we had 0 down 40-year mortgages that the floodgates opened up. I was actually speaking to one of Don's colleagues, Craig Alexander, who said in 2007 that the vast majority of all the mortgages being issued at that bank and across most banks were 0 down 40-year. So if the underlying story is one of leverage, that you've got assets without much capital backing it up. The deleveraging phenomenon is something that has to happen in households. It's now having to happen in governments who are trying to reduce their deficits. If everybody's deleveraging at the same time, there's got to be some source of cash building up. And then we talk about, there's this dead cash building up on corporate balance sheets. But it's like you push in a balloon someplace. 2 sectors of the economy are deleveraging or trying to, then another sector of the economy is going to re-leverage. So this deleveraging phenomenon is affecting the way our economies work, and it's actually dogging our rate of growth going forward. And Canada was not immune to that.
Susan, let me
Steve,
ask you.
Can I come in on that
please, Don,
point?
Go ahead.
Yeah. Well, we sort of painted a dynamic. Armin put it quite explicitly, the relative roles between the state governments and the markets. And so you can't just let banking go off on its own. I just want to point out that when we had that situation with a 40-year amortization of interest rates and you could borrow for the minimalist 5%, that was a government policy, and the banks hated it. And the banks lobbied intensely within Ottawa, kept it relatively quiet, but were lobbying intensely. That was a very foolish policy. Look at the International Monetary Fund, who the world turned to quote unquote save us from this mess. For 15 years, when they did the annual report on Canada, they recommended that the Canadian banks syndicate their high-risk mortgages. That is, don't hold them on your own books, divvy them up and sell them to investors. And for 15 years, I said to them, are you crazy? The fact that the Canadian banks have to hold these loans on their books makes them risk averse. This is a good behavior. The minute the whole financial crisis blew, I called the IMF and said, are you going to make that recommendation again? And it has not appeared since. So they were encouraging us to go down. The governments were encouraging the financial system, and even the IMF was encouraging the financial system to be riskier.
That was one of the elements of this whole story that didn't necessarily get a lot of play at the time. There was certainly abhorrence about how the banks behaved. There was abhorrence at how the Fannie Mae's and Freddie Mac's behaved, abhorrence at how the rating agencies completely overvalued this worthless crap. But the notion that politicians were telling these institutions, go out there and make it easier for people who can't borrow to take on debt that they can't handle, that did play a role in all of this too, didn't it?
Oh, for sure. I mean, I think, in 1999, when you had sort of the removal of the Glass-Steagall Act, which was the separation of the, you saw sort of this deregulation that was happening in the United States. And I should add, one of the things I think which was a saving grace in Canada is that we just did not have as developed a securitization market. And part of that is because of the benefit of, again, of having these large banks. The large banks could diversify. They could hold mortgages across the country, whereas in the US, they were prevented from going across states. That meant they held only mortgages in their certain area. They had to sell them because they were so undiversified. So because you had such a fragmented regulatory system, basically you were forcing them to engage in this kind of activity. So
let's understand, though, Brian, two words in the United States strike fear into the hearts of many: DoddFrank. This is the multi-thousand-page bill that eventually, I guess, nicknamed Wall Street reform. Here's all the things that we're telling the banks to do differently now, or they are down there, so that they don't misbehave like they used to.
Well,
what's the status of it today?
Well, this was the great reforms that were supposed to come in the wake of the world's biggest financial crisis and the global recession. And Dodd-Frank was a significant piece of legislation, was passed, I think, in 2010 finally. About 40% of it has been implemented since then. The problem is that each step of this reform process requires a massive rewriting and instituting of regulations. And everybody knew, including the banks, that it would take years before they could figure out how to implement these things, and that's been going on. The banks were lobbying to water everything down the day after it was passed. The legislators said, well, we did our job, it's now up to the regulators, they can sort all this out. But as was mentioned earlier, the Americans have a lot of different regulatory bodies with a lot of turf to protect, and that's what's been going on. So the SEC regulates the markets, the Fed and the Federal Deposit Insurance Corporation and the controller of the currency regulate the banks. Then you've got another organization that regulates derivatives. And Dodd-Frank was supposed to deal with all of these things. And some of the recommendations made a lot of sense, which is improve your capital base. That's been done. Make derivatives more transparent, figure out who's holding what. That makes a lot of sense. That hasn't quite been implemented yet, but it's getting closer. And then there was the Volcker part of it, which was passed as part of this thing. Paul Volcker, the former Fed chairman, came up with a 1.5-page proposal which said, just stop banks that take deposits and government insurance from trading on their own behalf and making money and stuff that has nothing to do with the business, the core business of banking.
That's the Volcker principle.
That's the Volcker principle.
And what have they done with that?
Nothing yet.
Still waiting.
They're hoping to have this implemented by 2014. That's the deadline. So far, none of it's been implemented. But some banks have already started to get rid of the subgroups inside the organizations that were doing this self-dealing because they know that it's coming anyway. So they've stopped trading for their own accounts.
Let me go to Armin on that. As we get further away from 5 years ago and the first-hand memories of all of the pain that caused become lessened, are you concerned that people are going to lose the, whatever it was, the fire to get these new regulations in place and we run the risk of going through this all over again?
Oh, that's a really good question. I have to say, as everybody's been talking, I've been thinking about really the underlying propelling thing. And the regulatory system, you know, you said that the governments had kind of pushed for 0 down 40-year. But governments were lobbied very heavily by mortgage insurers. And that all came back from a much older government policy from the United States, the ownership society that Mr. Bush pushed forward. And we just got data from the National Household Survey talking about how many Canadians own their own home. And you have to understand that the reason why home ownership has gone up to 70% in Canada is in part because incomes are not rising as quickly. Same story in the United States. In fact, most households are not seeing gains from growth. This just takes us back to dough. You know, I feel like I'm in some kind of a musical, right? This brings us back to dough, where everything seems to go back to, if you're not getting the gains from growth, are there ways you can kind of parlay more economic security and leveraging your way into an asset, you know, so that your money doesn't go into a black hole every month through a rent check, that you're actually building up equity, is one way for people to say, well, if everything goes belly up, I can liquidate my home and get some cash out of it. And in the meantime, I can also draw on it as its value goes up. This is like we're just playing games now. And it all goes back to, DoddFrank's latest incarnation was the SEC ruling that said you have to disclose how much not only the CEO makes in your firm, but what the average worker makes, because this is what this game has been about. It's why isn't the majority of citizens getting the benefit from economic growth? Why is so much of the gains from growth being concentrated at the top, and we're all gambling that we can get into and stay in the middle class by leveraging our way in there with household debt?
I thought part of the idea behind the last federal election in the United States, Obama over Romney, was in fact to make sure that this income inequality and that the other 99% would have their issues more attended to up front. Why hasn't that happened?
Well, I get there's been a real big fight on the part of the banks, as Brian has said. Like, nobody wants to give up what they've got. And in the context of slow economic growth, it becomes more like a zero-sum game. If you take something from the folks at the top to give to the bottom, it does look like a zero-sum game, and that's when friction starts picking up. So everybody wants faster economic growth so you can ride on the jet, on the fumes of that, and make it less fractious.
It's not enough to make 600 times more than your employees? You have to make 700 times more than your employees?
You don't have to ask
Yeah. Okay. Let's, Don, I want to bring you in here because I want to talk about another thing that has been employed, in particular by the Fed in the United States, to help get us out of the Great Recession that started 5 years ago this month, and that's something called quantitative easing. Now, people who are regular watchers of this program will know we did a whole hour on quantitative easing, and the ratings went through the roof. You can imagine it. But we did it. And
try teaching a class.
Andrew Coyne was very impressed. He was on the panel and he came out afterwards and said, wow, you guys did a whole hour on quantitative easing. I am so impressed. Thank you, Andrew. But anyway, Don, would you give us the handy-dandy definition of what that is and why the United States is still doing it?
Well, quantitative easing is essentially, once you've reached your limit of lowering interest rates, you can't make them negative. You make them as close to zero as you can, like Japan's done for a longer time. You want to provide additional liquidity, and you start buying up government bonds, and you buy up hard assets, and you just keep blowing up the balance sheet of your central bank, as the United States principally, but the European Bank has done that to a considerable degree as well. I think perhaps the most interesting implication of this whole thing is actually for monetary policy. If you had asked a central banker in 2006 what they thought of the world, they would have said it's mind-numbingly boring because we've solved everything. We have determined that if you keep inflation low, you guarantee financial stability. All we need to do is keep inflation low, and they did. This was the first economic crisis we've ever had that has not been predated by a run-up inflation, yet we still had it without having an inflation problem. And now we've proven 5 years into this, there really is nothing the monetary policy authorities can do to fix everything in a short period of time. They've been running this quantitative easing, near zero interest rates for 5 years, and they're snowplowing a lot of damage. They are undermining the very fabric of society because they're hammering savers. We're told to save. It's the ethical thing to do. It's the source of long-run growth. You're just being absolutely hammered as a saver. You're being rewarded for borrowing recklessly. And talk to a pension plan. You cannot operate a pension plan on a viable basis when you're getting 1.8% for a long-term bond yield. And it encourages foolish behavior on their part as well. A huge problem there, and I'm not sure they really figured out how to get out of that.
Susan, were you surprised the other day when Ben Bernanke, the chairman of the Fed in the States, said, we're going to keep it up?
Yeah, I guess I'm not that surprised because I think part of it is also trying to manage people's expectations. So once they've sort of said that, making a radical change at this stage is going to be kind of difficult for them to do. They've kind of dug themselves into a hole where they have to continue to perpetuate this. And I completely agree with Don's comments on the fact that it creates this kind of risk-taking behavior on the part of different, pension plans. Around the world. So it is, it's not surprising that they're continuing with it. I think the bigger question is, I think the only way they're actually going to stop is if they see changes in the inflation rate, which we have not seen. But, you've been pumping money into the system, but it's not doing the stimulus that we've sort of kind of textbook scene. You know, you're supposed to pump money into the system and get people.
Congress won't do that. So this is what they've got left.
Yeah, this is all they have left. But you know, you lower your interest rates in hopes that this is going to stimulate the economy, and you're just not seeing that type of reaction.
Right.
Well, it's not filtering through to the economy because it's inflating assets like bonds and equities, and the banks are smart. They say, wait a minute, I don't have to lend this money out to people who may not pay me back. I can just buy treasuries with this stuff and leave it back at the central bank. This is a great deal for me. And that's the problem with quantitative easing.
But surely Bernanke knows that, and yet he's doing it anyway.
Well, my view is that it doesn't work, but he had no choice. He literally had no choice to do the first round. He probably had no choice to do the second round, but now we're up into the third, and he may have to keep doing it because he's not going to get the economic results that he says he needs before he stops doing it. Now, he's soon going to be replaced. His replacement will have to continue this. And when interest rates stay as low as that, you have the problem that you have now in Canada, where our interest rates are a little bit higher, but they're still historically low. And then you have the Bank of Canada saying, well, people are borrowing too much. Well, what a shock.
You made it so easy.
Exactly.
Yeah.
So of course we're going to take out mortgages we won't be able to afford if rates ever go up. But that's the time bomb that sits there in the economy.
Who's the time bomb?
Steve, I wonder if I could take
Don?
this into just a tad of economic history, because I think that might get one or two more viewers than quantitative easing, and I know how popular economic history is. So essentially what we're living in is what John Maynard Keynes described in the Great Depression, a gigantic liquidity trap, that no matter what you do, no matter how cheap you make money, people don't want to spend it. And his recommendation, of course, what happened at that time was massive spending on the part of governments. And that has been the response of the Japanese government since they've gone in their economic standstill since 1990, and they continue to do that. But the other important lesson is that we have discovered that the appetite for governments everywhere else in the world to provide fiscal stimulus is 24 months. They massively and simultaneously goosed up their spending in the spring of 2009, and massively and simultaneously they switched to a draconian austerity environment in the spring of 2011. So we've proven now that the fiscal policy can't get you out the hole. When monetary policy is stymied by this so-called liquidity trap, you can't really exploit the fiscal policy tool for very long. That's a pretty sobering thought going forward as well.
Armin, do you have I mean, I know you're an economist and not a political scientist, but that is an interesting observation, that you get about 2 years and then the politicians think, okay, no more pump priming, we got to rein it all in. And that's obviously not the way you think it ought to go.
Well, presumably we should have learned our lesson from the 1930s, because that's exactly what happened in the 1930s. We turned on the tap, turn it off, things go bad again, turn it on again, turn it off, like that whole stop-start was part of what dragged that story on so far. But in terms of the story that Brian was talking about with this liquidity trap, and Don was talking about with the liquidity trap, Don was mentioning that it really hammers savers. But again, the underlying story here is that not only the majority of people in most countries are unable to save because of their income levels, but the whole next generation isn't able to even get launched. Forget about saving, finding a job, and becoming more of a I won't say a burden, but an additional cost to households that do have incomes. So we have got this like kind of 1-2 punch where saving needs to be protected because we're going to have the biggest cohort of retirees ever. So, you know, not being able to reward people for saving is a huge demographic, social, and economic problem. On the other hand, the majority of your population is losing ground in terms of its incomes. Just a quick thing that I did for the Globe and Mail this week, I tried to parallel the study done in the United States that I was talking about before. The bottom 50% of Canadian tax filers lost 22% of their income during the recession and have gained 3% of it back since 2009. That means they've lost ground. That's half the population. That probably bleeds up higher into the income spectrum. But if people are losing ground, they're not saving more. You can't afford to keep beating people down when they're already down.
No, they're treading water, I guess, aren't they?
Yeah, and you know, if you lower the interest rate, you're absolutely right. Your assets will go up in terms of equities, but also in terms of housing prices, and that's what we keep seeing in the markets, right? Like, it just won't quit. Our housing markets just won't quit. Prices keep going up, and yet people are in there.
In our last 10 minutes then, let's focus on this. One of the things that would be terrible about the last 5 years is if we learned nothing from it, made insignificant changes to ensure that what's happened won't happen again. And I want to get a sense from the four of you as to whether or not we have made adequate changes, significant enough changes to make sure that we don't go through the kind of financial systems near collapse that the world experienced 5 years ago. Don, you want to start us on that? How well have we done to make sure that we don't get a repeat of 5 years ago this month?
Oh, I think we've done very poorly, but it's a horrific task because I think we have learned quite a bit about what we don't know, and it cuts to the very core. So first, Armin mentioned this in a manner at the beginning. Our fundamental understanding of human and hence corporate behavior has to be reevaluated. Certainly by 2006, the predominant thought was people acted rationally. And how could you explain somebody in California who took 100% of their property value in a mortgage and allowed the value of that mortgage to be indexed to go up over time? That seems to be either terribly misinformed, downright stupid, or at least not very rational, and companies didn't behave in a rational form. We have discovered the world economy is far more sophisticated and far more connected than any of the models we look at. For example, here in Canada, the Bank of Canada and the Department of Finance, monetary policy in the whole financial sector is only measured by the interest rate and the exchange rate, and neither one of those variables did us in. All these internet connections and asset values and stuff do not get properly represented in any of those models. You mentioned credit rating agencies. We haven't touched upon that. That is about as sick a governance model as you can imagine. If I want to float a bond, I pay the credit rating agency to give a rating on my bond. Now, I know these people, they're very good and they're very honorable, but come on.
That's a built-in conflict of interest.
It's absolutely a conflict of interest. We've been sort of casting nasty things about the United States and the rest of the world in the financial sector, but let's not forget in Canada we had our own crises, the asset-backed commercial paper that was raised by the non-banks. It was $35 billion and it absolutely got wiped out. And it only had one rating agency rate it. You have to shake your head and say, how could they possibly come up with any rating, never mind a favorable rating? 1 year after that market blew up, one of the bank CEOs, I won't mention who, it wasn't TD, said, after a year of forensic counting, we still don't know what was in that basket of asset-backed commercial paper that we bought 12 months ago. And you wonder, if after a year they couldn't figure out what was in that, how did a rating agency ever come up with a rating? That really hasn't changed very much since. The world is more interconnected. Everything, you know, we had the Asian crises in the late 1990s that didn't really affect the global economy. It would today because emerging economies are a lot bigger. We have every central bank in the world changing policy in exactly the same fashion at the same time. The fiscal policy authorities doing the same thing. When the subprime mortgage market blew up in the United States, the first two high-profile casualties were Australian hedge fund and a Norwegian community that had bought this stuff. This stuff goes fast and it goes far. So the world economy is a different place, and I don't think we have a sophisticated enough understanding of that to figure out how to conduct the right policies.
Susan, 5 years later, how are we doing?
I would agree 100% with Don. I mean, I think one of the things that I think keeps me up and worried is really, I alluded to this earlier, the shadow banking system, which is very much what Don was describing. It's a lot of these activities which are not under the banking system. And I think what's happened with regulation is they've gone specifically at the banks because that's probably the easiest way to regulate. You say, okay, we're going to force you to hold more capital to absorb losses. But what that does is it kind of squeezes all of the other activity out of the banking sector, where it's going to be more fluid. So the repo markets, the money market funds, the asset-backed commercial paper, the securitization markets, all of these are part of the shadow banking system, which are kind of doing the jobs of a bank, but don't have access to a central banking, and they're not as strictly regulated. And I think, you know, and part of the reason they're not being regulated is it's very difficult to regulate them, right? So we're asking in the repo market to track what's happening with collateral.
Difficult to regulate because even the regulators don't understand what they're up to?
Well, so there's a balance there, right? In terms of you want to provide liquidity. They're doing a good job in terms of providing liquidity in the marketplace. And so there's always this big call, if we restrict this is going to sort of have a restriction in the economy. But I really think that sort of how do we regulate? Do we put capital in money markets? There's a large discussion on should we move to a fixed or floating rate within the money market movements. And this is because the money markets now are becoming a channel for short-term borrowing, which used to happen through the banks.
Hermine.
So what am I worried about here 5 years later?
5 years later. Have we made the changes? Are we sure enough, because of the changes we've made, that we're not going to see a repeat of 5 years ago?
I think we've extended the problem that dogged first world markets to the emerging markets. So nobody wants to pay workers more. Everybody wants to pay workers less. And part of the answer to that is go securitize your own future and we'll give you easy money. Easy money now is threatening to blow up China. And if that happens, if the credit failure happens in China, 5 years later, this is the story in the news this week. So I think we're poised for a repeat performance, rinse and repeat. The cycle is set to just repeat itself because we don't want to pay, as consumers, we don't want to pay high prices. We want cheap stuff. If you want cheap stuff, the flip of cheap things that you buy are cheap wages, and we keep shoving the wages down. And there are bully capitalists out there that are rubbing their hands and saying, "Great, I'm going to pay you less." But we're looking at this kind of global geopolitical shift between turning our backs on our own middle class here in the first world countries and praising them as they emerge in emerging markets. Oh wow, we've got a whole new middle class emerging in a new market. Terrific. While we let this one go down the tubes and watch that one rise on the back of credit and easy money. I just think we haven't learned our lesson at all.
Brian, you get the last word on this.
Well, there's no question that the biggest global concern, I think, should still be the derivatives market, which is still essentially unregulated. We're talking about a market that's 20 times larger than the global economy. We're talking quadrillion here. It's massive, and most regulators have no handle on this. That's globally. In Canada, I worry most about all these home buyers with mortgages that they can barely afford now because rates will inevitably rise. There's no way to prevent that, and most of these people are going to be underwater.
You say rates will inevitably rise.
Inevitably.
Right, but we have been hearing that for quite a long time now.
It's going to get closer.
Well,
Steve, they're down at rates that we didn't even have in the 1930s. Like, they're below any historic records. Mm-hmm. So Brian is right. They have nowhere to go but up.
They have nowhere to go but up, but it might be 1, 2, 3, 4, 5 years before they go up.
Yeah,
it's called the normalization of global rates, and it's already happening. It's happening regardless of what the central banks are doing. It's happening in the United States, and it will happen here.
When?
It can be a matter of months, it can be a matter of years, but it will happen, and the people who barely can manage those payments now are going to be way underwater.
And if that happens,
then we'll have a collapse of our own housing
Here we
market.
go again.
Yeah, here we go again.
Here we
Rinse
go
and
again.
repeat. Yeah.
The definition of insanity, people,
Yeah.
is what?
Keep doing what you've always been doing and hope for a different
and expect
outcome.
a different outcome. Yes, indeed. I want to thank all four of you for coming in tonight and helping us out with this story. Don Drummond from Queen's University on the line from the nation's capital. Don, it's good to have you on the program again. I hope you'll join us again soon. Here in studio, Armin Yalnizyan from the Canadian Centre for Policy Alternatives. Susan Christofferson, first time on the program. Glad to have you along.
It was great to be
Associate
here.
Professor of Finance at the Rotman School of Management at U of T. And our old pal Brian Milner, who's been coming to these parts for I'd say 20 years or so,
Really?
almost.
That long?
Well, you were on Studio 2 back in the day as well. So
I was indeed.
we've been seeing you around here for a long time. Senior economics writer, global markets columnist, The Globe and Mail. Thanks so much, everybody.
Support Ontario's public television. Donate at tvo.org.